December 2025. Right this second, what you're hearing from the financial media is dead wrong. Not because anyone's deliberately deceiving you, but because they're completely ignoring what the numbers are screaming at us. Everyone keeps saying the economy is strong and everything's under control. But that's what they read, not telling you. 14 critical warning signals are lighting up right now. These are the exact same signals that appeared right before the 2008 financial meltdown. The identical signals that showed up before the dot-com bubble burst in 2000. The very same warnings that flashed before the legendary 1929 crash. And every single signal is telling us the same terrifying story. We re-headed straight toward a catastrophic market crash. This isn't some distant future problem. This isn't happening in a decade. The crash window? We're looking at 12 to 24 months from today, somewhere between the middle of 2026 and the end of 2027. The wheels are already turning. Time is running out fast. And here's the harsh truth. There's absolutely nothing that can prevent this collapse anymore. We can only push it back slightly. Your window to take action? Just 18 months? 18 months to pull your money out of high-risk investments. 18 months to cut down your debt exposure. 18 months before we witness the biggest transfer of wealth since the 2008 crisis, wiping out everyone who wasn't prepared while making fortunes for those who saw it coming. This isn't me being dramatic. This isn't some panic-driven prediction. This is simple math working itself out to its unavoidable conclusion. Once I show you the pattern that's been playing out like clockwork for the past 100 years, you'll realize why this crash isn't just likely, it's absolutely guaranteed to happen. At this very moment, America's economy is sitting in the danger zone of the longest boom period we've ever recorded. This massive bull run that kicked off back in March 2009 is now pushing into its 16th year. Look at history. Economic booms typically run for 5 to 7 years, tops. The record holder before this? The 90s expansion that lasted 10 years before imploding in the dot-com disaster. Our current run has blown past that by over 50%. We're now 6 full years beyond what history tells us is normal. But here's the thing, markets don't crash just because they're old. Crashes happen because of specific circumstances. Precise, quantifiable warning signs that create a house of cards ready to collapse. And here's what's chilling. Every major financial disaster follows the exact same 4-step blueprint. Step 1 is wild optimism combined with skyrocketing prices. Step 2 is red flags popping up everywhere while everyone pretends not to see them. Step 3 is some unexpected event that shows how fragile everything really is. Step 4 is the domino effect as panic selling creates an unstoppable downward spiral. Right now, we're deep into Step 2. The warning lights are blazing, but just like in 1929, just like in 2000, just like in 2008, the people who should be sounding the alarm are brushing it all off. History shows us this pattern fails exactly 0 times. Let me walk you through 3 examples covering almost a century, because this pattern never, ever changes. Back in 1929, America was living through the roaring 20s. Stock prices had exploded nearly 400% in under 10 years. Revolutionary technologies like cars, radios, and electricity were changing everything. Everyone was incredibly optimistic. The entire country was throwing money into stocks. And here's the dangerous part. People were increasingly buying on borrowed money, using margin to multiply their bets. Margin borrowing hit 12% of the entire economy. But underneath all this apparent success, trouble was brewing. Farm prices had been crashing since 1926. People were drowning in personal debt at record levels. The yield curve flipped upside down in 1928, which always signals recession ahead. Florida's commercial real estate had already crashed in 1926 after an insane bubble. Banks were making increasingly risky loans, yet economists kept saying everything was perfect. Irving Fisher, literally the most respected economist in the country, announced in September 1929 that stocks had hit what appears to be a permanently high plateau. Just 1 month later, October 24, 1929, Black Thursday hit. The market imploded 11% in one trading day. By October 29th, Black Tuesday, another 12% vanished. The bleeding continued for 3 straight years. By July 1932, the Dow Jones had collapsed 89% from its highest point. $30 billion in wealth simply evaporated. 9,000 banks went under. 1 in 4 workers lost their jobs. Factory output was cut in half. Every warning sign was visible, but the experts waved them away. Regular investors paid no attention, and countless people lost absolutely everything because they convinced themselves things were different this time. Fast forward to 2000. The internet boom had convinced an entire generation that the old playbook was obsolete. The web was revolutionizing the world. Companies with zero actual profits were worth billions purely on hype. The Nasdaq rocketed up 400% in just 5 years, jumping from 1,000 in 1995 to over 5,000 by March 2000. Regular people were quitting their jobs to become full-time day traders. Everyone was certain the rules had changed permanently, but danger signs were flashing everywhere. The yield curve inverted in 2000. Corporate borrowing was at all-time highs. Margin debt reached 2.7% of GDP, the worst level since 1929. Tech companies were trading at 100 times their earnings or even higher. Tons of companies weren't making any profit at all. The Federal Reserve had jacked up interest rates from 4.75% all the way to 6.5% by May 2000. Wall Street experts kept insisting that valuations were irrelevant in this new digital economy. They said traditional measurements were outdated nonsense. Then March 10, 2000 arrived. $5 trillion in market value got obliterated. People's retirement savings got slashed in half. Hundreds of internet companies completely disappeared. All the warning signs were there, but the experts dismissed every single one. And millions of people watched their fortunes disappear because they believed things were different this time. Now, jump to 2008. The housing craze had convinced Americans that property values only move in one direction, up. Between 2000 and 2006, home prices doubled across the country. Real estate became everyone's ticket to wealth. And increasingly, buyers were using subprime loans, requiring zero down payment, no proof of income, and no assets whatsoever. Banks were thrilled because they didn't keep these risky mortgages. They'd create the loans and instantly flip them to investment banks, who would bundle thousands together into complex securities. Everyone collected fees at every step, but by 2006 the cracks were showing. New home construction peaked and started dropping. Mortgage failures started climbing in early 2007. The yield curve had flipped in 2006. Consumer borrowing was at record highs. Big financial institutions were leveraged 30 to 1, meaning just a 3% loss would destroy them completely. Ben Bernanke claimed in 2007 that subprime issues would stay contained. Treasury Secretary Hank Paulson insisted the financial system was rock solid. They couldn't have been more wrong. Then September 15, 2008 happened. Lehman Brothers went bankrupt. Credit markets completely froze. The S&P 500 plummeted 57% from top to bottom. $11 trillion in family wealth vanished. Unemployment jumped to 10%. Almost 9 million Americans lost their jobs. Every warning sign was visible. The experts ignored all of them. And millions lost everything. 3 devastating crashes. 3 separate decades. But the identical pattern every single time. Crazy overvaluation. Easy money flowing, mounting debt everywhere. Warning indicators screaming danger. Experts swearing things are different now. Then total collapse. Now look at where we are today, December 2025. America's total stock market value sits around $60 trillion, while our GDP is roughly $26 trillion. That means the BUFFETT indicator is at approximately 230%. The normal historical level is 100%. This indicator peaked at 148% in 2000 right before the tech crash. It hit 105% in 2007 before 2008's meltdown. Today, we're at 230%. This is the most overpriced market in recorded history. The Schiller Cape ratio is sitting close to 39 right now. The historical norm is 17. This ratio peaked at 44 in December 1999 before the dot-com collapse. It maxed at 27 in October 2007 before 2008. We're currently at 39. Stocks are priced at more than double what they're actually worth historically. Margin debt is still hovering near record territory at roughly $800 billion, approaching 3% of GDP. There have only been 3 other moments when margin debt climbed this high: 1929, 2000, and 2007. Every single time, a massive crash followed. When stock prices fall, brokers demand more money, forcing people to sell. This panic selling pushes prices even lower, triggering more demands for money, forcing even more selling. It becomes a devastating feedback loop. Corporate borrowing has ballooned to roughly $14 trillion, nearly 50% of GDP. The historical norm is around 35%. Most of this corporate debt was created between 2020 and 2021 at super cheap rates of 2% or 3%. Now that debt is coming due and companies have to refinance at 5% or 6%. This doubles or triples what they're paying in interest. A company that was paying $60 million annually in interest will now be paying $180 million. That's an extra $120 million coming straight out of their profits. Stock prices have to drop to reflect this reality, but they haven't adjusted yet. Commercial real estate keeps getting worse. Office building vacancy rates are sitting between 20 and 30%. Property values have dropped 40 to 60% from their 2021 peaks. A building valued at $200 million in 2021 might only be worth $100 million now. But that same building still has a $150 million loan on it. The property is underwater by $50 million. And about $1.5 trillion in commercial real estate loans are coming due between now and 2027. When these loans mature, borrowers need to either refinance or pay up. Banks won't refinance properties that are underwater, which means massive defaults are coming. And these defaults are going to hammer regional banks. Regional banks are still dangerously vulnerable despite getting bailed out in 2023. Between March and May 2023, 3 major banks failed: Silicon Valley Bank, Signature Bank, and First Republic. The collapses only stopped because the Federal Reserve stepped in with emergency money, but the core problems never got fixed. Regional banks are holding approximately $1.3 trillion in commercial real estate loans that are going bad. When these losses hit the books, bank capital will be wiped out, triggering more bank failures and people panicking to withdraw their money. This is exactly the same thing that happened in 2008. Consumer debt has now crossed $18 trillion. Credit card debt is over $1.2 trillion at average rates near 22%. Auto loans total over $1.6 trillion. Student loan debt sits around $1.77 trillion. Late payments are climbing in every single category. Credit card delinquencies have jumped from 2.1% in 2021 to over 3.2% by late 2025. When consumers are drowning in debt and falling behind on payments, lenders stop lending and consumers stop spending. Both forces push us straight toward recession. The personal savings rate has collapsed from 16% during COVID, relief payments to roughly 4% by late 2025. The historical average is 9%. American families have no safety net left. When job losses start, people have zero reserves. They immediately fall behind on bills, default on loans, and stop all non-essential spending. This makes the recession happen faster and hit harder. And employment has quietly crept up from 3.4% in early 2023 to around 4.5% by late 2025. That's a 1.1 percentage point jump. We crossed that line months ago. The SAM rule has successfully predicted every recession since 1970 without a single mistake. We're not moving toward recession. We're already in the beginning stages right now. Manufacturing has stayed in decline for most of the last 2 years. The ISM Manufacturing Index has been below 50 for most months since early 2023. When manufacturing enters recession, the broader economy typically follows within 6 to 12 months. This signal is screaming that recession is already here. Leading economic indicators have been falling for over 20 straight months through late 2025. This is the longest continuous drop since 2007-2008. The leading economic index is specifically designed to forecast recessions 6 to 12 months ahead. 20 months of continuous decline is screaming that recession is right around the corner. Yet stock markets are still trading near their all-time peaks. The Federal Reserve is completely boxed in. After pushing rates from 0 to 5.5%, they've cut back down to around 4.5% by late 2025. If they cut rates too fast, inflation comes roaring back. If they keep rates high, they trigger the recession that's already building. There's no escape route that avoids major pain. The Fed is just trying to control when the crash happens. They can't stop it. Global tensions remain dangerously high. U.S.-China conflicts over Taiwan, the war in Ukraine, Middle East instability. Any of these could explode into a shock that ripples through the entire financial system. In a system this overleveraged with prices this extreme, any shock can become the trigger. The specific trigger doesn't actually matter. The system itself is fragile and ready to break. These 14 indicators aren't guesses about the future. They're describing what's happening right now. These are hard facts. And all 14 are flashing red at the same time. Based on how this has played out historically, here's the likely timeline. Through Q1 2026, markets stay elevated. Optimism continues despite growing weakness underneath. Corporate earnings start missing targets. Defaults accelerate in commercial real estate and corporate debt. By Q2 2026, the stress becomes impossible to hide. A trigger event hits. This could be a major company bankruptcy, a bank collapse, a geopolitical crisis, or derivatives exploding. Credit markets lock up. Stock prices drop 15% to 20%. Forced selling begins. By Q3 2026, the cascade is accelerating fast. The S&P 500 falls another 20% to 25%. We're now down 35% to 45% from the peak. Hedge funds start blowing up. Regular investors panic and dump everything. Unemployment spikes toward 7%. Consumer spending collapses completely. By Q4 2026, we hit rock bottom. The S&P 500 has crashed to somewhere between 2,700 and 3,500, representing a 50% to 60% decline. Trillions in wealth have been erased. Unemployment peaks between 8% and 9%. The Federal Reserve has slashed rates back to zero and fired up the money printer again. The crash has finished running its course. In 2027, recovery slowly starts taking hold. Early movers who protected their capital make incredible returns buying at the bottom. But the majority who ignored all the warnings and sold near the bottom never recover their losses. Their retirement dreams are shattered. This isn't me making predictions. This is basic mathematics working itself out. The S&P 500 is trading at 6,900 today. The historical average CAPE ratio is 17. The current ratio is 39. To get back to historical average, stock prices must fall 56%, from 6,900 down to approximately 3,000. Valuations always return to the average without exception. The Buffett indicator sits at 230% of GDP. Historical average is 100%. To return to normal levels, total market value must fall 57%, from roughly $60 trillion down to $26 trillion. Corporate debt payments are exploding as cheap debt refinances at 3 times the old rate. This represents hundreds of billions in extra annual interest costs. That money has to come from somewhere. Company profits. When profits fall, stock prices must fall. Commercial real estate loans totaling $1.5 trillion are maturing over the next 24 months. These buildings are worth 40% to 60% less than what's owed on them. Expected losses will exceed $600 billion. Banks will either become insolvent or need bailouts. This isn't speculation or theory. This is basic arithmetic. The debt exists, the interest rates are real, the losses are inevitable. But the damage to unprepared people will be permanent and devastating. The difference between people who get destroyed and people who survive and thrive isn't about intelligence or luck. It's about preparation. Your window? Roughly 18 months? Back in January 2008, the S&P 500 sat at 1,400. Smart investors cut their stock exposure, built up cash reserves, moved money into treasury bonds and gold. By March 2009, the market bottomed at 680, down 51%. The people who prepared in early 2008 kept their wealth safe and bought everything at bargain prices. The people who believed the optimistic experts lost half their net worth. If someone had pulled you aside in January 2008 and told you a crash was 9 months away, would you have listened and acted? I'm telling you right now, the crash is 12 to 18 months away. The warning indicators are even clearer than they were in 2008. The overvaluation is more extreme than ever. The debt levels are higher than we've ever seen. Make your decisions based on this reality. The crash is coming with mathematical certainty. The same 14 warning indicators that successfully predicted every major crash since 1929 are all flashing red simultaneously right now. The valuations can't be sustained. The debt can't be paid. The entire system is too overleveraged. When it finally breaks, the collapse will be violent, lightning fast, and absolutely merciless. You've got 18 months to get ready. 18 months to reduce your risk exposure. 18 months to build up cash reserves. 18 months before the biggest wealth transfer since 2008 separates those who prepared from those who didn't. The pattern is crystal clear. The timeline is locked in. The crash is unavoidable. The only question that matters is, will you be ready when it hits? If this video showed you the 14 red flags that are flashing right now, if you understand why current valuations are mathematically impossible to maintain, if you can see this historical pattern repeating itself once again, you need to act immediately. You have 18 months. This pattern has been repeating itself for over a century, and it's happening again right now, right in front of us. Understanding this pattern is your first step to surviving what's about to unfold.